Dan Ives, the global head of tech research at Wedbush Securities, says this tech panic is a huge mistake and that there is massive opportunity ahead. In this video, we're breaking down exactly what he means and what it could signal for investors right now. He recently joined Bloomberg to talk about how the tech sector is holding up despite rising tensions in the Middle East. I'm going to show you the clip first, then I'll give you my full breakdown and reaction. After that, I'll walk you through 3 stocks that are trading at a discount right now and could deliver massive upside as the AI revolution continues to accelerate. Make sure to like the video, share it, and drop your thoughts in the comments. Subscribe so you don't miss the next update. Let's hear what Dan Ives has to say.
Yeah, look, you have to have feet on the ground to be talking not just to investors, but companies. I mean, what's happening in Taiwan? What does memory look like in Korea? Are there shortages because of the Strait? The point is, these are the things, and we've talked about on the show for many years. Like, it's what I believe. It's the only way you can navigate this environment to understand what demand looks like, and trying to basically understand some of the patterns that we're seeing.
What have you learned? The clear rumors here is there's a filter down from $109 barrel of oil into technology. Do you observe that?
Look, I'd say right now there is one clearly sentiment. It's a white knuckle environment for tech. But when you look at demand to supply, in terms of just what we're seeing in terms of demand in Taiwan, it's robust. It's robust not just for NVIDIA, but it's robust for memory and for the components. And what that ultimately means is that's going to be bullish for the hyperscalers. And look, the backdrop is obviously nervous, but I just think it's very important in these environments to understand what the trends are, because this will pass. And when it passes, tech stocks, I continue to believe that's where you want to be positioned, especially in some of these sell-offs that we've seen.
Dan, what's the conversation you're having with clients over there in Asia about some of the structural concerns about software stocks in general, software as a service stocks in particular? How do you frame that out for your clients?
Yeah, Paul, I think it's as negative a sentiment as I've seen in software, not just in Asia, but I think just across the world, that I've seen probably going back 10 years or more. Because right now, every investor, they're focused on semis, hardware, no one wants to touch software. And I continue to believe that is a massively disconnected narrative from the reality of what we're going to see in the use cases from Microsoft to Oracle to Salesforce to ServiceNow. And I think we're going through one of those periods here where these stocks are on massive sale, in my opinion, relative to where we see them heading as part of the AI revolution.
So how do you try to differentiate between potential winners, potential losers in the software space, Dan? How do you step back and assess that?
Yeah, I think to some extent, I'll call it a AI ghost trade in terms of Anthropic and some of the worries about that. These LLM models, Anthropic in particular, is going to basically unseat software. So I think you have to separate between, are there some companies that could be at risk? Yeah, of course, like to some of the pure plays. But when you look at install base entrenched stack players like Salesforce, ServiceNow, Oracle, cybersecurity, CrowdStrike, Palo Alto, look, we talk to the customers. How are they going about architecture? How are they building these use cases? And that's where Palantir again and again continues to also stick out positively.
From Kuala Lumpur, Malaysia, Dan Ives with us. Thrilled he could be with us to get our Monday started. Dan, Paul Sweeney taught me this. MSFT Equity EE, which is the earnings and estimate screen for beleaguered Microsoft, forward 12-month PE 21.26. I mean, I know you're going to tell me it's a bargain, it's a broken record, but I want to understand, Dan Ives, the durability of their margins down the income statement, given these shocks, into Q3, into Q4, into the first quarter of 2027. Is it possible to guesstimate that?
Look, I mean, when I look at Microsoft right now, we're talking about multiples in a free cash flow basis and on earnings that we haven't seen, you going back 8 years, 10 years, relative to where I believe. And I think from a margin perspective, it's free cash flow type of growth that's going to be in the mid to high teens. next 2 to 3 years or higher than that, it all comes down to 10% of their base have upgraded or gone down the path for AI. If we're 10% right, this is a 500 to 550 stock. If we're base case right, it's 6 to 650. That's how
Right.
I think it continues to be the most disconnected stock in tech, period.
Right, Paul, the debt load, 3.3%. It's just backbreaking.
Hey, Dan, talk to us about cybersecurity here. How do you think about cybersecurity in the world of AI? Because it just seems like, boy, the risk could be just exponentially higher.
Yeah, Paul, the budgets are going to increase from 5% of IT to 10% next 2 to 3 years. Because the surface area, if every person has if every person has 5 agents working out there for enterprises, that's just going to expand the surface area. So what that means, cybersecurity, the budget's that much more strategic. That's not going to be unseated from Anthropic or OpenAI. It speaks to our view. CrowdStrike, Palo Alto, Checkpoint, Rubrics. Like these are names that are going to have massively bigger opportunities than they do today. But it's another example that the AI ghost trade is a black cloud over the sector.
Right from the beginning, Dan Ives sets the tone by emphasizing something that I personally think a lot of retail investors overlook. He talks about having feet on the ground in places like Taiwan and Korea. That's not just a throwaway comment. What he's really saying is that macro headlines and stock price movements don't tell the full story. If you actually want to understand where tech is going, you need to look at supply chains, chip production, memory demand, and real-world activity happening in those regions. And this is important because Taiwan and Korea are basically the backbone of the global semiconductor industry. So when he says demand there is robust, that's a strong signal. Despite all the fear in the market, despite oil prices rising, despite geopolitical concerns, the actual demand for chips and components is still very strong. Now here's where things start to get interesting. He describes the current tech environment as white knuckle, which basically means investors are nervous, volatile, and unsure. And honestly, I agree with that. If you've been watching the market lately, it feels like sentiment can flip in a single day. One headline sends stocks down, another sends them back up. But what Ives is doing is separating sentiment from fundamentals, and that's a key distinction. Because while investors are panicking, he's saying the underlying demand is still there, and if that's true, then what we're seeing right now could actually be a disconnect between price and reality, and this is where his bullish stance comes in. He basically says that when this period of uncertainty passes, tech stocks are still the place you want to be. Not energy, not defensive sectors, but tech, especially during sell-offs. Now, personally, I think this is where you have to be a bit careful. Because yes, historically, buying tech during fear has worked. But not every dip is automatically a buying opportunity. Some companies are overvalued, some narratives don't play out, and sometimes the market reprices for a reason. That said, I do agree with his broader point. If the fundamentals are strong and the sell-off is driven mostly by sentiment, that's where opportunities are created. Then the conversation shifts into software, and this is probably one of the most important parts of the interview. Ives says that sentiment around software stocks is as negative as he's seen in over a decade. Think about that. Over 10 years. That includes multiple market cycles. And the reason is pretty clear. Right now, everyone is focused on semiconductors and hardware. AI chips, GPUs, infrastructure. That's where the excitement is. Meanwhile, software is being ignored. But Ives calls this a massively disconnected narrative. And this is where his thesis gets really compelling. He's basically saying that while hardware is getting all the attention, the real long-term value of AI will be realized through software. And if you think about it, that actually makes a lot of sense. Hardware enables AI, but software is where AI gets applied. That's where the use cases live. That's where companies actually generate revenue from AI. So when he mentions companies like Microsoft, Oracle, Salesforce, and ServiceNow, he's pointing to platforms that are already deeply embedded in enterprise ecosystems. These are not small players that can easily be disrupted overnight. Now, he does acknowledge that some companies could be at risk, especially smaller pure-play software names, and I think that's a very important nuance. Because not all software companies are equal. Some have strong moats, massive install bases, and deep integration into business operations. Others are more vulnerable, especially if AI can replicate or replace what they do. And this is where I actually think investors need to be very selective. You can't just buy software as a category and expect to win. You need to identify which companies are building real AI-driven value and which ones are just riding the hype. Then we get into Microsoft, and Ives is extremely bullish here. He talks about valuation levels that we haven't seen in years, especially relative to free cash flow and earnings. In his view, Microsoft is trading at a discount compared to where it should be, and his argument is centered around growth and margins. He's projecting mid to high teens free cash flow growth over the next couple of years, potentially even higher. And he ties a lot of that upside to AI adoption, specifically how much of Microsoft's customer base upgrades and integrates AI into their workflows. He throws out some pretty aggressive price targets, suggesting that if adoption hits certain levels, the stock could be significantly higher. Now, here's my take on that. I do think Microsoft is one of the best-positioned companies in the AI space. Their integration across cloud, enterprise software, and AI tools gives them a huge advantage. But at the same time, a lot of that optimism is already baked into expectations. So while the long-term story is strong, the path there might not be as smooth as Ives makes it sound. Then the conversation shifts again, this time to cybersecurity, and this is another area where I think he makes a very strong point. He talks about how AI is expanding the attack surface for companies. Basically, the more AI agents, tools, and systems you have operating, the more potential entry points there are for cyber threats. And because of that, he expects cybersecurity budgets to double from about 5% of IT spending to around 10% over the next few years. That's a massive shift. And if that plays out, companies in the cybersecurity space could see huge growth opportunities. He mentions names like CrowdStrike, Palo Alto, and others, positioning them as long-term winners in this environment. And honestly, this is one area where I strongly agree with him. Cybersecurity is not optional. It's not something companies can cut back on when times get tough. If anything, it becomes more critical as systems become more complex and interconnected. So when you combine AI expansion with rising cyber threats, it creates a very powerful tailwind for that sector. But he also points out something interesting toward the end, which is that AI itself is casting a black cloud over the market. And what he means by that is that while AI is driving growth and opportunity, it's also creating fear and uncertainty. Investors are worried about disruption, about which companies will win and which will lose. And that uncertainty is contributing to the negative sentiment we're seeing, especially in software. So when you step back and look at the entire interview, the core message from Dan Ives is actually pretty clear. The market is nervous, sentiment is weak, and there's a lot of fear around AI and macro conditions. But underneath all of that, the fundamentals in key areas like semiconductors, software, and cybersecurity remain strong. And because of that disconnect, he sees opportunity. Now, whether you fully agree with him or not, I think the key takeaway here is understanding that markets are often driven by emotion in the short term and fundamentals in the long term. Right now, emotion is dominating. But if Ives is right, and the fundamentals continue to hold, then this period could end up being one of those moments where the best opportunities were hiding in plain sight while everyone else was too focused on the fear to see them. Now let's dive in and talk about the 3 powerful tech stocks that are quietly trading at a discount right now and could deliver massive upside as the AI revolution continues to accelerate. Let's start with the first stock, Meta Platforms, ticker symbol META. Before we even talk about numbers, you need to understand why Meta matters more today than it ever has before. Meta is not just a social media company, it is one of the largest attention platforms on the planet. Billions of people use its products daily, including Facebook, Instagram, and WhatsApp. That scale gives Meta something extremely valuable in the AI era, which is data. Massive amounts of real-time human interaction data that can be used to train and refine AI systems at a level very few companies can match. And this is where the market is getting it wrong. A lot of investors still think of Meta as a mature advertising business that has already peaked. But what they are missing is how AI is transforming Meta's core business and unlocking new growth layers. Meta has been aggressively integrating AI into its advertising engine. This is not just about targeting ads better. It is about improving conversion rates, increasing return on ad spend, and making the platform more valuable to advertisers. When AI helps businesses get better results, they spend more money. It is that simple. And we are already seeing that play out. Meta's ad revenue has been accelerating, driven by improved performance from AI-powered recommendation systems. The company has rebuilt its ad infrastructure in a way that is now delivering stronger engagement and better monetization across its platforms. At the same time, Meta is also building its own AI ecosystem. From open-source models to AI assistants integrated across its apps, Meta is positioning itself not just as a user of AI but as a major player in shaping how AI is deployed at scale. Now let's talk about why this stock is being considered a discount opportunity. The market recently pulled back on tech stocks due to macro uncertainty, rising geopolitical tensions, and concerns about interest rates. That pullback did not spare Meta, even though its underlying business continues to perform strongly. This creates a disconnect. You have a company with improving fundamentals, strong revenue growth, and expanding margins, but the stock price has not fully reflected that progress. From a financial standpoint, Meta has been delivering solid revenue growth, supported by its advertising engine and growing user engagement. Its profitability has also improved significantly as the company has focused on efficiency, cutting costs, while still investing heavily in AI and future technologies. What makes Meta particularly attractive here is its combination of growth and cash generation. This is a company that produces massive free cash flow, which gives it the flexibility to invest in innovation, return capital to shareholders, and weather economic uncertainty better than most. And here is something I personally think a lot of investors are underestimating: Meta's ability to adapt. This is a company that has faced multiple challenges over the years, from privacy changes to competition to shifts in user behavior. And every time it has managed to evolve and come out stronger. Right now, AI is the next big shift, and Meta is not falling behind. It is leaning into it aggressively. So when you look at the current valuation compared to the long-term growth potential driven by AI, improved advertising efficiency, and its massive user base, it becomes clear why this could be a discounted opportunity. You are essentially getting a dominant digital platform with strong cash flow and a clear AI strategy at a price that does not fully reflect its future potential. And in my opinion, that is where smart investors start paying attention, because the market often misprices companies during periods of uncertainty. But when that uncertainty fades, the stocks that were unfairly discounted tend to move first and fastest. Meta fits that profile right now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second stock, and this is where the entire AI narrative really starts to accelerate in a big way. NVIDIA, ticker symbol NVDA. If Meta is the platform where AI is applied, NVIDIA is the engine that makes AI possible in the first place. Every major advancement you are seeing in artificial intelligence today is being powered by high-performance computing, and NVIDIA sits right at the center of that ecosystem. Its graphics processing units have become the backbone of AI training and inference, and demand for these chips has exploded as companies race to build and deploy AI models. This is not a short-term trend. This is a structural shift in how computing works. We are moving from traditional CPU-driven workloads to GPU-accelerated computing, especially for AI, machine learning, and data-intensive applications. And NVIDIA has spent years building a lead in this space that is extremely difficult to replicate. What makes NVIDIA so dominant is not just its hardware, it is the entire ecosystem. From its 𝗗𝗜𝗦 software platform to its developer tools and libraries, NVIDIA has created a deeply integrated environment that developers rely on. Once companies build on NVIDIA's architecture, switching away becomes very difficult. That creates a powerful moat that goes beyond just selling chips. Now here is where things get interesting from an investment standpoint. Despite NVIDIA's incredible growth, the stock has experienced periods of volatility, especially during broader tech sell-offs. When macro fears hit the market, even the strongest companies can see their valuations compress. And that is exactly where opportunity can start to emerge. Because when you zoom out and look at the demand drivers, they are still very much intact. Data centers are expanding aggressively to support AI workloads. Cloud providers are investing heavily in infrastructure. Enterprises are beginning to integrate AI into their operations. All of this requires massive computing power, and NVIDIA is the primary supplier of that power. In other words, the demand is not slowing down. If anything, it is accelerating. From a financial perspective, NVIDIA has been delivering exceptional growth. Revenue has surged, driven largely by its data center segment, which has become the dominant part of its business. Margins have also expanded as demand for its high-end chips remains strong. And this is where I want to add a bit of my own perspective. A lot of investors look at NVIDIA and think it is already too expensive, or that they have missed the move. And while it is true that the stock has performed incredibly well over time, I think that view can sometimes miss the bigger picture. Because this is not just a cyclical growth story. This is a foundational shift in technology. If AI continues to grow the way many expect, then the demand for computing power could remain elevated for years, and NVIDIA, being the leader in this space, stands to benefit significantly from that trend. Now, that does not mean there are no risks. Competition is increasing. Other companies are trying to develop their own AI chips. There are also concerns about supply constraints and how sustainable current demand levels are. But when you weigh those risks against NVIDIA's current position, its ecosystem, and its role in enabling AI, it becomes clear why many analysts still see long-term upside. And here is the key point. When high-quality companies like NVIDIA pull back due to broader market conditions rather than fundamental weakness, those moments can create entry opportunities for long-term investors. You are not buying into hype at the peak. You are buying into strength during temporary weakness. That is a very different strategy. So when you combine NVIDIA's dominant position in AI infrastructure, its strong financial performance, and the ongoing demand for its products, it starts to make sense why this stock is being viewed as a discounted opportunity in the current environment. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the third stock, and this one is often overlooked compared to the first two, but it plays a critical role in the entire AI ecosystem. Micron Technology, ticker symbol MU. If NVIDIA is the engine powering AI, Micron is supplying the fuel that keeps that engine running. Micron specializes in memory and storage solutions, specifically DRAM and NAND. These are essential components in modern computing, and they become even more important in the age of AI. AI workloads require massive amounts of data to be processed quickly, and that means higher demand for high-performance memory. This is where Micron comes in. Every AI model that gets trained, every data center that gets scaled, and every high-performance system that gets deployed relies heavily on memory. And as AI continues to expand, the need for faster and more efficient memory solutions grows alongside it. Now here is what makes Micron particularly interesting right now. Unlike Meta and NVIDIA, which are often seen as obvious AI winners, Micron is still viewed by many investors as a cyclical semiconductor company. Its performance has historically been tied to supply and demand cycles in the memory market, which can lead to periods of volatility. And that perception is exactly what creates the opportunity, because while Micron does operate in a cyclical industry, the AI boom is introducing a structural demand driver that could change the dynamics of that cycle. We are starting to see a shift where demand for memory is not just coming from traditional sources like personal computers and smartphones, but increasingly from data centers and AI applications. These use cases require significantly more memory per system, which can drive sustained demand over time. From a financial standpoint, Micron has been navigating through a challenging period, but there are clear signs of recovery. Pricing in the memory market has started to stabilize, and demand is picking up as inventory levels normalize. As this cycle turns, Micron is positioned to benefit from improving pricing and stronger demand, especially from AI-related applications. And here is where I want to add my own take. Micron is not as flashy as NVIDIA or as widely recognized as Meta, but that is exactly why it can be interesting. Sometimes the best opportunities are not the most obvious ones. They are the ones that are quietly benefiting from a major trend without getting all the attention. That said, you do have to be realistic about the risks. Micron's business is still tied to supply cycles. If supply increases too quickly or demand slows down unexpectedly, pricing can come under pressure again. That is something investors need to keep in mind. But if you believe that AI-driven demand for memory will continue to grow, then Micron stands to benefit in a meaningful way, and when you combine that with a valuation that has been pressured by past cyclical weakness, you start to see why this could be considered a discounted opportunity. So when you step back and look at all three stocks together, a clear pattern emerges. You have Meta, which is leveraging AI to enhance its platforms and drive monetization. You have NVIDIA, which is providing the core infrastructure that powers AI. And then you have Micron, which is supplying the memory that makes large-scale AI computation possible. Each company plays a different role, but they are all connected to the same long-term trend, and that is what makes this setup so compelling. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now here is something I want you to think about. Out of these three companies, which one do you believe has the strongest long-term advantage in the AI space, and why? Is it the platform, the infrastructure, or the underlying components that will drive the most value over time? Let me know your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.